Let me start with the hard truth. Most people don't lose money investing because they picked the wrong stock. They lose money because they never built a system. They guess, they react, they panic, and they overtrade. Meanwhile, some of the wealthiest investors on earth are quietly compounding money with one of the most boring tools available, ETFs. And by the end of this episode, you're going to understand what ETFs actually are, why they outperform most investors, which specific ETFs fit different investing goals, and how to think like an owner instead of a gambler. Now, this is not hype, and I'm not gatekeeping any information in this episode. This is going to be a masterclass, and I'm excited to dive into it. Let's do it. Hey, if you're new here, my name is Jamil Frazier. I'm a former welfare kid who built a 9-figure business, became a multi-millionaire, an accredited investor, a real estate investor by the age of 38. And now I teach families and entrepreneurs how to build wealth, create income, invest with confidence, and shift their financial future. If that's something that you want, you are in the right place. So let's start with some data. According to S&P Dow Jones SPIVA reports, 80 to 90% of professional fund managers fail to beat the S&P 500 over a 15-year time period. That means people who are Ivy League educated, paid millions of dollars, surrounded by the greatest analysts, still lose to simple index investing. Now, here's the part that really hurts. According to Dalbar's study, the average investor only earns 3 to 4% annually, while the stock market historically has returned about 10%. So that gap is not intelligence. That gap is poor behavior. So people buy when they're excited and they sell when they're scared. They react to headlines instead of fundamentals. ETFs helps remove you from that equation. So let's discuss what an ETF actually is, and I'm going to simplify this for you. An ETF is nothing more than a basket of companies packaged into one investment that trades like a stock. So instead of betting on one company or one CEO or one product, you actually own the entire markets or strategies. One ETF can actually hold dozens of companies or hundreds of companies, sometimes thousands of companies. And that matters because individual companies fail. Markets always adapt and indexes tend to rebalance. So ETFs are designed for ownership, not prediction. Now you're thinking, okay, Jamil, why do simple returns win? Well, let's just talk the math. If you invest $10,000 and earn just 3% annually, that $10,000 is going to grow to about $24,000 over a 30-year time period. That same $10,000 invested at 7% annually will give you about $76,000 over 30 years. But get this, that same $10,000 invested at 10% annually will return about $174,000. That's the same money, but completely different outcomes. The S&P 500 has averaged roughly 10% returns annually since 1926. That's 100 years of fantastic returns through wars, recessions, pandemics, and political chaos. Markets reward time and ownership, not genius and not IQs. So here are 4 types of ETFs that I want you to understand before you walk away from this video. Let's take a look at the first type. This is what I call your dividend or your income ETF. Your dividend ETFs are designed for one thing, cash flow with stability. So this category is best for people who might just be recently retired, or you're near retirement, or you're just a conservative investor, or you might be somebody who just wants income without actually selling your asset. Think about this as like a rental property, but it's actually a stock or an ETF. So here are 2 dividend ETFs worth taking a look at. The first one is SCHD. This is your Schwab US Dividend Equity ETF. Now, SCHD focuses on high quality companies with strong balance sheets and sustainable dividends. Now, this is not a chase yield ETF. This is a quality first income strategy. Historically, this ETF has lower volatility than the broader market, but also has its dividend yield often around 3 to 4%. So many long-term income investors use SCHD as a core holding. Second, let's take a look at VGI. This is your Vanguard Dividend Appreciation ETF. VGI focuses on companies that increase their dividend year after year. So why does that matter? Because dividend growth has historically protect against inflation and improve long-term returns. This is income plus compounding. It's almost like getting the best of both worlds. The second type of ETF are your growth and tech ETFs. Your growth ETFs are designed for long-term wealth building. Now, this category is best for people who are high income earners, or you just have long timelines. Or you might be an investor who can emotionally handle volatility. Here are two growth ETFs to understand. The first one that we'll dive into is QQQ. This is your NASDAQ 100 ETF. QQQ owns the top 100 non-financial companies on the NASDAQ. That means heavy exposure to technology, innovation, AI, and cloud infrastructure. Historically, QQQ has outperformed the S&P 500 over long periods, but it comes with higher volatility. So this is not a conservative investment. This is growth with conviction. Next, let's dive into VUG. This is your Vanguard Growth ETF. Now, VUG gives you growth exposure across multiple sectors, not just tech. It's less concentrated than QQQ, but it also has slightly lower volatility, but still is growth oriented. This is a strong option for investors who want growth without extreme swings. Now, the third type of ETF is what I call your balance or your core ETF. Now, to me, this is your most important category. If someone could only own one ETF for the next 30 years, it would likely come from this category. Core ETFs represent ownership of the economy. So the first ETF that we'll look at is VOO. This is Vanguard's S&P 500 ETF. I personally have hundreds and thousands, if not millions of dollars invested in this one ETF. Now, VOO owns the top 500 largest companies in the United States. Historically, it has had roughly 10% annual returns long term, and it is the benchmark for most portfolios, and it is the benchmark that most portfolios fail to beat. If America grows, you win. Second, VTI. This is Vanguard's total stock market ETF. Now, VTI owns small companies, mid-sized companies, and large companies. It's the entire US stock market in one fund. This is a true set it and forget it foundation. The fourth type of ETF to understand is your international ETF. International ETFs help reduce US only risk. I have, again, tons of money invested into international ETFs. Now, this category is best for those who are long-term planners and those who want globally diversified portfolios. This includes ETFs like VXUS, which is Vanguard's total international stock ETF. Now, VXUS gives exposure to developed markets, emerging markets, and everything outside of the United States. This is a broad global diversification all in one ETF. Next, we have VWO. This is Vanguard's Emerging Markets ETF. This ETF focuses on developing economies, which means higher volatility and higher long-term growth potential. Now, this is not conservative. It's a long-term satellite holding. Okay, so Jamil, how do I actually build a portfolio? Here's the framework that I use. Step one, define your goal. You have to figure out, do you want income, growth, or balance? Step two, define your timeline. Do you want to invest for a year, 5 years, or 30 years? Step three, choose 2 to 4 ETFs, not 20 like a lot of people do. Over diversification actually will lower your returns and increase your confusion. Step four, automate contributions. Consistency beats brilliance. And step five, stay invested. Missing just the 10 best market days over 20 years can reduce returns by over 50%. Fear is expensive, folks. So what's the real risk? Simply stated, it's you. Markets don't destroy wealth. People do. Panic selling, chasing hype, sitting in cash while inflation eats your purchasing power. Cash loses value. Ownership compounds value. ETFs help you stay invested, reduce emotions, and think for the long term. So as we land this plane, I know ETFs aren't exciting. I know they're not sexy, but neither is working forever. Wealth is built by owning productive assets, staying consistent, ignoring the noise, and letting time do the heavy lifting. You don't need brilliance. You don't need to be smart, and you don't need a high IQ. You just need a plan. Well, friend, there you have it. ETFs aren't exciting, I know, but wealth isn't built on excitement. It's built on discipline, ownership, and time. And before I let you go, if you want help creating a simple income producing system like this one, go sign up for my next 1 Day to Wealth free investing class. You'll find a link right here in the description. And I want to give a special shout out to Jacqueline and Nicole Sicard and Maria Cibrian for joining my inner circle this week. If you have found any value from this video, I want to encourage you to like and subscribe and drop a comment below and let me know which type of investor do you feel is the best fit for you. Until the next time, say it with me, no lazy money.